Welcome everyone to this Market Thursday. It's Thursday the 13th of May. It's 1 o'clock here in London. And as usual, just a quick disclaimer. Those webinars are not investment advice. This is purely for information. So please do your own research before putting any position. Clearly, this is for education. Going quickly into my background, I started in 2000 as a cash equity trader in Paris. Then I moved in 2004 to London, where I was hedge fund manager for 4 years, working first on the long only product, then on the long short product. Then in 2009, I joined Infinity Capital Markets, where I worked for 9 years as prop trader. No mandate, absolute mandate, no asset regions and constraint. Then in 2014, I joined another mentoring company and I left in 2017. We started my own education program in 2018, both with the mentoring and the video series 18 months ago. And since the start of this year, we started doing some prop trading again for First New York. So I'm doing both prop trading and education. So I'm mentoring people from all over the world. So what are we going to be covering today? As usual, we're going to be starting with the situation across asset classes, looking at the 4 asset classes, how they have been doing. So we are in the middle of a sell-off in the equity market. So market is selling off now. We had 40.60 on the S&P futures. We were last Friday at 42.30. So we are down 170 points, roughly 4% on the S&P, a bit more on the NASDAQ. We're going to be looking at inflation. So the market has been struggling with the latest data from the CPI. Sorry for the noise in the background, for the CPI that came out yesterday, which was a bit high. So we're going to see versus the expectation. Then we're going to be talking about one of the reports that we like, that we cover in the 4x4 video series, which is the Small Businesses Report, which is the NFIB, and explaining to you why it should be in your filtering process. Then actually, we're not going to be doing this special situation, this spin-off. So there's an interesting spin-off in Europe with Kinnevik, which is spinning off Zalando shares. So there's going to be a dual listing for a month. It's listed in Germany. There's going to be for sellers. So there's going to be a lot of things to do. So that's probably something that I will put in the community. So let's start with situation across asset classes. So that's the year-to-date asset performances. As you can see on the left-hand side, what is interesting is now, as of yesterday, so as of the close of Wednesday, the 12th, the NASDAQ is almost flat on the year. For the other asset classes, talking not asset classes, sorry, stocks, we are up 8% on the S&P, roughly same for the Russell 2000. And actually, European stocks, despite the weakness this morning, have been doing pretty well versus the S&P, and are outperforming a bit. In the middle here, you can see that emerging market, where people were really hot coming into the year, actually have been struggling. So EEM, which is the ETF for emerging market, has been underperforming the SPY, the S&P 500, since January. Why? Because the emerging market are struggling to deal with COVID. So there is a bit of time delay between developed markets and emerging markets. For the currencies, here, the currencies, you can see that versus the Japanese yen, but to be honest, the dollar has been weakening 2 to 5% versus currencies. Versus the euro dollar, it is moving between the 118 and 123. So some weakening of the dollar, but not as much as we had from March to December of last year. Bitcoin's coming down. I mean, it's at 5,000 roughly. Gold is down on the year, and WTI is massively up 36%. So week to date, what's the picture? So the picture is is very different, and we're not used to having those kind of pictures. So actually, if you look at the drawdown that we had in the market since the lows of March, we didn't have that many. There was one in June and some shake-up in September. But the S&P is down 2.5% week on week. NASDAQ is down 4%. So you can see across different regions, the market has been pretty weak, but the US clearly has been underperforming. As we're going to discuss again, this is mostly due to inflation and the CPI numbers yesterday. Currencies, again, based on the volatility monthly, weekly, you can be looking at ATR. By definition, they will be moving much less than the equity market. Gold, a bit of a bounce. WTI, as we're going to be checking with technical analysis, has been testing the 66.50 level, which is an important level that we tested before the move to the low and the high 50s. If we carry on with the 11 sectors of the S&P, so year to date, picture has not been changing much for the energy, which has been really, really strong. Financials based on the steepening of the yield curve, and as well of the overall 10 years, 30 years yields going higher, that has been helping the industry. On the other hand of the spectrum, you know, some industries have been struggling based on that, like utilities. And the defensive so far have been underperforming a bit the market. Anything that has been cyclical, industrials and materials. So materials recently has been very, very strong. I don't know if you've been checking, but over the last 3 months, very strong move in the materials. Based on moves like FCX and commodities by definition. So strong sector. What you can see as well is for this year, there has been a lot of dispersion between the winners and the losers. So that means despite the S&P up 8%, you have sectors, industries that are outperforming massively. So if you've been wrong on your sector picker or on the industry picking, that has been quite a killer. That is very much the case in Europe, where you have many hedge funds that actually are down on the year when the stock 600 is up almost 10%. Week to date, consumer discretionary been destroyed. IT, technology, by definition, again, has been really struggling. Next slide, going into the last 5 days. So when we do the 4x4, when we do the mentoring, we start with the index level, then we jump into the sector level, then we jump into the next level, which is the industries level. That helps us massively to generate ideas and to understand what is moving in the market. So that's the last 5 days picture. And actually what is interesting is you can see that the solar, the ticker is TAN, T-A-N, has been really, really struggling over the last 5 days. It used to be between 115 and 120 3 months ago. Now it's in the low 70s, high 60s. Semiconductors, housing actually has been very weak over the last couple of days. So the name like Pulte have been really coming down. And on the other end of the spectrum, again, oil services, which had a good bounce. Materials, you know, flat almost over the last 5 days. So again, there is a lot of dispersion in this market, and we need to be. I mean, you need to be listening to what the market is telling you here, which is last year there was the rally of at one stage everything was moving. Was here, you know, it is important to do some sector and stock picking. Quickly, as you know me now, this is something that we have done since the start of the year, because, you know, the biggest risk factor for the market is from the central banks, when the central banks will be doing something, when they will be changing their policy, and if they will be changing their policy. So between every webinar, we're looking at the Fed expectation through the Euro-dollar futures. So the Euro-dollar futures tell us, you know, when market participants are expecting the Fed to be, in that case, hiking rates. So here, that was a couple of weeks ago, that was for December 2022, which is at 99.56, which is at a very similar level now. So what is interesting is, despite all the noise in the equity market that has been selling off, the bond market is more or less telling you the same picture. We're going to have a look as well at the 10 years. The 10 years has been moving a bit, but not that much. So it's like, suddenly the equity market have been looking at the data and say, oh, actually there's a CPI. Oh, there is inflation. So not that surprising. This is something that we discussed last month when we look at the CPI. I've been, if you're following me on Twitter, I've been saying that, this CPI data was extremely important. Why? Because the market is more and more short-term driven. So, long time ago, people were telling you, oh, you should be looking 3 to 6 months, and it's still very true. So that means you should be looking what's going to happen next. But very much like the Fed, which is data dependent, when there is a bad print on the day, market is reacting quite a lot, despite the numbers which was expected. Last time I didn't put that slide, and again, it's to put everything into context. When we look at putting risk in the market, this is the central bank's balance sheets. On the left-hand side, the Fed, and on the right-hand side, the ECB, which tells you that the level of activity from the central banks and interventions by quantitative easing is still massive. So as it is still massive, it's going to have an impact when and how they're going to reduce the amount of quantitative easing that they will do in the future. Let's jump now into the price action, and let me looking at technical analysis. Let me do that. Can you still see the screen? Yes. So that's the VIX. So the VIX, which is the implied volatility on the S&P 500. What was really surprising over since Friday. So on Friday we had the NFIB. Numbers were a bit rubbish. The market went up on this. Then, we started to have a bit of a sell-off on the fear of inflation that was, accelerated on Wednesday, with the CPI. Having said that, we are only 4%, as I say, from the all-time high on the S&P, meaning, we only got a 4% sell-off. So if you look at yesterday's sell-off of 2% on the S&P, actually, the VIX went from here, if we look here, up. The S&P went from 22% to 27%. So that is a huge move in terms of implied volatility versus by how much the underlying has been moving. What has been interesting over the last, each time there is a move, before we had some kind of a move 3 weeks ago when the S&P, I don't know if you remember, just after the expiry, only went down by 1%, and the VIX had a spike as well. So very much like the new metric or the new market condition makes that a small move on the underlying makes really big move on the implied volatility. If we look at now the S&P futures, because I think this is still the best way to look at it. So we have been looking at this trend since November. Okay, so the trend has been since the 3600 up and up and up. So we discussed that as long as this trend is not broken, the trend is up. Having said that, as I mentioned before, based on the upside that you have, which is 1 to 2 to let's say to 3% top, the risk reward as a trader is very often, if you have 3% as a short and with your stop loss here, and the potential is unlimited, you get a potential and really as a risk reward to put a bit of short exposure. Okay, having said that, the market has been running, and it's always easy to say you should have been short when the market is coming down, which is always what you see on Twitter. So we're going to see later what kind of the trades you could have been doing. Still, in terms of where is the market after this level, it feels like, you have the 39.70, which is a level. So unless we come back very quickly to the 41.20, and that's the beauty of this market, it could come back to 41.20 at this close, on this close. There has been some deterioration in the overall market. If you look at the Nasdaq Composite, which has been suffering a bit more as the S&P. Having said that, the Nasdaq was pretty strong versus the S&P yesterday. So there are some very short-term signs that the sell-off that was first, mainly, I want to be selling growth because growth is going to be struggling more than yields going up. That is not necessarily the case. There has been a case yesterday. There was a follow-up, and really S&P, Dow Jones were really struggling. If you look at the picture, so the long-term picture, so here we are looking at the weekly chart, and that will be a logarithmic chart. We have been breaking away from this long trend that we started in 2010, sorry. So in terms of real first support that we can see based on the 50 days, based on this trend, we are talking 12,000, which gives you another 5 to 6%. That's the potential lower bound of this move, which has been really strong. If you look at as I said, at the Nasdaq versus, so let's do QQQ versus the SPY. Okay, so actually this is the picture of the QQQ versus the SPY. We are making highs. It's very much like the S&P. It's breaking, and we are trading below the 20 days. Now the Russell, which has been outperforming the overall market since the election, clearly this one is broken. Okay, that is a logarithmic weekly chart. It is broken. So there are stories that are telling you that the trend that we had since the election now is done and dusted. Question, as always, is: are we consolidating from here? Because normally you don't see like a retracement to the bottom. I didn't want too much to do some Fibonacci retracement because it's always a bit dodgy where to find the levels, and you never know. But mostly what you'll be looking at is the different volumes on the S&P and the overall market. Sectors that I mentioned before, so that's the TAN sector. So that is from the solar, which was hot. Again, it was broken at the end of February. One of the levels, I don't know where exactly is the level, so it's going to be, again, I don't like to be trying to catch the bottom. If we look at what is XME, so XME extremely strong. If we look as well at Bank, so Bank has been leading the overall market. Having said that, they didn't make new highs over this week, but clearly, if you look at the Wells Fargo, the JP Morgan first has been really strong. So this is for the equity market, where picture is not as strong as it was before. So here, this is the one that I'm really following, which is, sorry, and then we're going to jump into other asset classes, which is the XLI. So industrial sector, which is obviously has been one of the plays of the recovery of this new cycle. It feels, as always, it's last. You have to take a pinch of salt with technical analysis and be looking at where is going to be the close on the wick. But at least we are testing the trend. So several indicators, both growth, cyclical, industrial, even defensive, are telling us that the big move that we had is coming to at least a stop. In terms of seasonality, this is something that we discussed as well. We knew that previous month, the month of April, is a very good month normally in terms of risk on. May is not, I mean, sell in May and go away is not that correct. And most of the time you're gonna have a small down market, but really the bad market most of the time is the June. It's the June one. There is some bad seasonality, and if you look at the calendar, we discussed that as well. There is obviously, instead of having 1 month, you're going to have 2 months of inflation. You're going to Fed, this Fed big meeting coming in June, and you get the biggest expiry of the quarter, which is coming as well in June. I want to discuss the US 10 years. So we're going to be looking at the yield. So that's the yield. Again, everyone is talking about inflation. We have been talking about inflation since the start of the year and before. If market participants are, sorry for my English, shitting in their pants because of inflation, you will see the 10 years much higher, at least over the last 2 months, which is not the case. So we have been consolidating between, so let's put this into a daily chart. We have been consolidating since the month of March between this 175% and 150%. So there is no acceleration in this. And as we discussed before, the euro-dollar futures are more or less pricing the same than it was a couple of months ago. So story is more or less the same on the bond market. It's just now that the equity market has been putting some risk off. The first move was, rotation. SPACs started to sell off, a couple of months ago, and now not only the growth, industrial, everything has been selling off on the news. Commodities. I want to quickly look at the CL1 because this one is interesting. So again, we are testing now this 66.5, 67 level. I have to be honest, I had conviction before that about the CL1 as a short. Now I'm not that sure because, the world is reopening on one hand, and OPEC is still managing the supply. I still believe that the demand is rubbish and is down 3 to 5% versus pre-crisis, and electrical vehicles are just making this harder. But just for the sake of it, it feels a bit squeezy. So that time I'm not going to go. Last time, when it was in the 65, I went short. This time I'm going to pass. I'm going to wait and see. Because it feels like based on this appetite from market participants to buy anything that is commodities, long cycle, restart of the economy, blah, 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 it could go higher. And we know that all the commodities are going higher. So that's the copper. And copper is, so let me give you a longer chart. Up, see, this is the chart for copper. So the trend is still there. Okay, nothing is broken, and actually it has not been selling off that much. So the underlying of the story of economy, world economy restarting, doing fine, a huge appetite for commodities is still there. So there are many things, that are telling you the picture is more or less the same that it was, let's say, a month ago, a couple of months ago. But as we had a massive run on the equity market with no correction, and actually last month was so strong, 5%, going up and up, no matter what the news were, it feels quite normal to have a correction. When you say it's not an issue to have a correction, it feels very much like the CNBC talk when, when the market is up, they will tell you they are long, and when the market is coming down, they will tell you that they were short. I've been telling you since the 4150 that having some small short exposure or neutral exposure was making sense. Having said that, the market, is not really coming down yet. It may be a wait and see, but that means, again, market could gap very quickly up. Euro dollar, the only one that I found interesting in terms of currency, this is this one. So this is the Chinese yuan. Kind of struggling at this level to have, so there has been some some hiccup around the 640. I think this is the one to watch. Why? Because there is a lot of talks and a lot of friction because between China and the rest of the world. So that's going to be interesting to watch if we get some follow-up and how China will be doing in the next 2 quarters, because they have been slowing versus the rest of the world. There is a lot, as I said, tension because of the world reopening and the world reopening a bit too quickly. Let's go back into the presentation, and after the balance sheet, I would like to discuss the inflation. So yesterday, I mean, you probably saw that we had the CPI. So on the left-hand side here, this is exactly the same table that we discussed a month ago when we did the webinar, which is for the March CPI. So that's the kind of tools that you have with the 4x4. You can see that the core CPI, which is at the bottom year on year, was at 165%, and 0.3% on the month on month. We knew because of the base effect based on last year where prices came down massively, that this month, or I should say the month of April, and coming with the data yesterday, will show a massive print up. Okay, so year on year, we are 3%. So we should not be, I mean, again, we should not be completely surprised. It always amazes me when the market is like, oh, there is inflation. Oh, what is this number? We knew that this number will be pretty big. Okay, so when I see all those guys on Twitter, either they don't follow the market or they don't understand how the CPI is calculated. What is more important now is the month on month. Okay, so the month on month is obviously printing a big level at 0.92. So let's see. So here you get the print. So the print is pretty big month on month. As you can see, it's if you look at any chart, that's going to be distorted. So it's a bit like the Bitcoin versus any asset classes. But the tale is obviously as the economy is reopening, you have a lot of demand on, you have huge demand right now before the months where everything was on lockdown. What you don't want to see is a follow-up and strong month-to-month CPI coming. We know what the Fed has been saying is it's going to be transitory. Don't worry, it's going to be fine. It is both true because, you know, as the economy is reopening, we have inflation, and that is just not true. Why? Because you have many other inflation, like, you know, commodities, for instance, because of the supply chain, that are making the story completely different. Plus, if you do a fiscal stimulus, if you give me 100, I'm going to be spending part of the money, which is different from the monetary stimulus. What we need to understand from the CPI from yesterday is there is distortion, and there is as well some effect like the used cars that are explaining almost 1% year-on-year change. So that is quite massive. Still, the Fed has been saying, guys, you know, we're not going to be doing anything because we are data dependent. Okay, and they say we know that inflation will coming up. We know that for 2 to 3 months, inflation will be there. As they are data dependent, if this inflation stays for too long, the market will force them to do something. Okay, so we got the first month. If you think about timing, the Fed meeting, the next one, this is the second month where they're going to have some data. Maybe they can still bullshit the market and say, well, look, maybe wait a bit. But, you know, if you look at this summer, and that's most market participants, some market participants are pricing. If you look at the Jackson Hole meeting, which is at the end of August, maybe the Fed will change the talks, and as well in September they will start to do some tapering somewhere. If you look at the central bank's balance sheet, they are still buying shitloads of bonds, so they are still very active. So based on that, you know, that will be making sense for them to be doing a bit of tapering. As the market is running on such a hot potato on steroids, you know, a small change, the market is very sensitive to those changes. But clearly, first data, which was the CPI, as you know, those of you who have been doing the 4x4, the Fed is mostly looking at the PCE. Okay, so the PCE, by the way it is calculated, is coming most of the time lower than the CPI. It's going to be coming in a couple of weeks. So you know, PC is probably last one was at 1.6, it's going to come at 2.2, 2.3%. I mean, I'm not an economist and I'm not pretend otherwise, but you know, it's still going to be probably above this 2% target. So as it's going to be above this 2% target, it's going to start to flash red for the Fed. So what is interesting from yesterday is actually the expectations. So that was here, you get the core PC. So the survey, we had a 2.3 and it came out at 3%. So the market was quite surprised. If you were running your own model, you know, that was not unexpected to have 2.6, 2.8% year on year. So again, it's overshooting. There is inflation and we don't know for how long. And I'm in the camp to say that actually there will be inflation. I don't know how much inflation, but I think the story with fiscal stimulus makes the world inflationary. And as we are all doing fiscal stimulus and we are all restarting together, that makes some inflation and some friction. But to give you a bit of color of what happened, so, and here you're looking at the S&P 500. So last Friday, 1:30 UK time, you get this NFP print, which was not great. So me, to give you some indication, you know, I went short around this level, okay? So I started to do a short. And, you know, everyone is looking at the screen and say, we know that the NFP is a lagging indicator. So what about, you know, my thought was next week, we know that we're going to have the CPI. So before the CPI, the market is going to be taking some positions off. So here you get the SPY that is this CPI that went out to 130. So me, I bought back around here, okay? Because my play is here is just to make a trade, is not to be playing the data. So it's like I don't want to be playing the earnings, but clearly the market here was very extended going into the CPI, keeping in mind that year on year the data had to be looking bad. So if we look the other way around, which is why as well I was comforted with this short S&P. So here you get the US 10 years. So when the NFP came out, the bonds started to go higher. Okay, so bonds going higher. So the yield started to sell off. I mean, bonds buying and sorry, yields going down, but actually on the day we were flat. So despite of all the noise of, you know, the Fed is not going to do anything because there is a bad print on the NFP, bond market was telling you, oh, we know this is a one-off. We know that actually probably there are some miscalculation in the NFP, but actually based on that, it doesn't change anything from the Fed policy. And guess what? You know, after that, on Monday, yields were at 1.6%, so they were higher. So to me, that was a clear signal that, you know, the bullshit about, you know, the Fed is going to be based on the NFP is not going to do much. If you had the CPI, the reaction was, you know, CPI coming, actually, that is not good for potentially for growth and for the overall equity market. So that is what happened. So I mean, the more educated you become, the less actually, the more you look at those news and you say, oh, news, the guy on Reuters, the guy on Bloomberg is telling you something, but the bond market, the equity market is telling you something else. So again, the sprint on the NFP was priced by the market as a one-off and not from the Fed actually to be postponing what they could have done. The most important thing that the market is considering for the Fed to move is inflation. For sure, it's inflation. If we have too much inflation and 2% plus for longer or for too long, the market will force the Fed to do something. And no matter what the Fed is saying or the central banks are saying, we are very independent. When market participants are pushing hard, they follow. So here, this is the core CPI, sorry, versus the 2% target of the Fed. Again, this is jumping higher. You can see that it feels a bit like a bit too much. We know what happened. Okay, we have all been living from home and the world have been in a lockdown. So now it's about how we're going to have inflation in the next 3 to 6 months. I think if you adjust from everything, it is probably still above this 2%, and it's going to be above 2% for the next 6 months at least. So question is, do we need so much activity from the Fed if inflation is running higher than what the mandate should be? So here we're looking at the inflation US break-even 10 years. So previous webinar, I think that was a Bloomberg page. Here it is from the Fed website. Again, if you don't have an account on the Fed website, if you want to build your macro, everything is for free. You just need to use a bit of Excel. That's not complicated. It was at 253% a couple of days ago, 256, I think, yesterday. So expectations are for inflation to be running higher than the 2%. It's still higher than it was a month ago, but it's not like moving to the 3% level. So again, bond market expectations are telling us there is a confirmation of inflation. The biggest risk is if the US 10 years go from 170% to 2% very quickly. As long as we go slowly but surely, meaning that there is a confirmation of the reopening of the world economy and the US economy, we should be doing fine. So based on that, you know, that is something that we discussed over and over and over, doing at the inflation and the rotation. So we started with the rotation theme in September last year. And this is a chart that I really like, which is the Russell ratio versus the NASDAQ versus the US 10 years. Meaning that when the 10 years, when the yields are going up, meaning that there is inflation, restart of the economy, value small is going to be outperforming the growth. So don't look at all those people that are complaining on Twitter that growth is down X%, that ARK is down 30%. Those stocks were crazy high, crazy valuation. You know, so when ARK goes from 160 to 100, you know, so be it. We knew that valuation were really too pushy. That means when you have those positions, first you have a reversion to the mean, okay, which is what we are having now, and then you can have a bit more because this 10-year move has been reversed over the last since September. So here this is the IWD, which is the Russell 1000 value versus the Russell 1000 growth. As you can see, there is still a long way to go. So why I want to mention that, because so here this is from Credit Suisse, and I think this is an interesting chart from Credit Suisse about the P of the Russell 1000 growth versus the value. So the blue is the Russell 1000 growth. The gray one is the value. As you can see, expectation, the P here, there has been a huge dislocation or a huge dispersion. So if you only think and believe in reversion to the mean, there will be no problem for these 30 times to go into 25 something. I don't know what exactly that be, but there is still some way to go. So you can blame me and say, look, Greg, today the NASDAQ is, or from yesterday, is bouncing versus the value, and you can give it for 3 days, 5 days, 1 week. But the trend is still, you know, probably for this trade to carry on for 20-30%. I don't have the timing, but, you know, I don't blame me and don't come to me with, oh, Greg, I could have been making 3-5%, because I'm fine with making 3-5%. But here, the trend is not going with you. That is the same here if you look at the rotation relative EPS growth, where here I think this is interesting. So this is the growth going slower versus the value going faster. As you can see, again, we are talking almost two standard deviation, and the trade is probably this one. If you think about that is COVID. COVID, we know COVID is over now. I mean, not completely over. I should never say that. And actually, sorry, oop, I retract that one. But actually, there is a chance that we go back close to the average. So think about growth versus value, your exposure. Let's discuss, as always. Now I want to do a bit of education with something that is discussed in the 4x4. So in the 4x4, we discussed the NFIB index and NFIB surveys, which stands for the National Federation Independent Business, which is a good leading indicator. This is a monthly survey conducted by the National Federation of Independent Business, where this is most of the time small companies. So typically companies that have 10 people and roughly $500,000 sales. And what is interesting, if you look at this survey, it's made of 10 companies. So you have many questions asked, and that means you can have several criteria for your ID generation. One of the downsides that you had recently, for instance, if you're based in Europe, if you're based non-US, is, I don't know if it's the Trump administration and the fear of the world, but now you can't have access to the data as the way you used to be. So either you use a VPN or you ask a US friend to send it to you. It's quite a long report, again, very helpful. What is important is the US economy, 62% roughly of small businesses accounted for the jobs jobs created in the US. So that's, if you think about how the US should be doing, you should be looking first at how the small companies, which are making roughly 2/3 of the job creation, are doing. And again, that is very helpful for the economic cycle, for the business confidence, how business owners think that they're going to be hiring, how they look at inflation and capital expenditure, for instance. And the good thing is it was created in 1974, which is, almost 50 years. So quite a long time. So you got a good history. Caveat, it's not as good as the ISM. Okay, the ISM is really the king of the leading indicator, but that is still very helpful. So here, this is the chart. So let's look at a chart that is interesting and to show you how it works. And I strongly advise you to build your own spreadsheet and your own macro indicators based on that. So in blue here, we get the NFIB optimism index, and in green with the conference board consumer confidence. So if you believe that consumer confidence, if you believe that it is a leading indicator, you have another leading indicator, which is more or less how small business owners think that you have a good index for 3 months, for 6 months, about how the business are going to be doing. Another one that is, so here, this is the outlook for general business conditions over 6 months. As you can see, expectation for the next 6 months have not been completely recovering. One of the things that is key with small businesses is they were really keen on Trump administration. So that means with the new administration, there is kind of struggling of the outlook. And finally, this is the chart that I really like, which is recently, because you're always using the chart that tells you something, So here you're looking about the higher prices, which is more or less, inflation. Okay, you don't need to be genius. So it's CPI. As you can see, we are making new highs. So again, many indicators that are telling you the same story. Bottom line of all of this is look at this NFIB report, very helpful. You're going to have on CapEx, you're going to have on interest rate, about inflation. Again, it's 2/3 of the economy, so that makes quite a big chunk. Quickly, because we're going to go back to trading. What time is it? Yes, it's 1:45. So S&P 4073 bouncing nicely. About education, so we offer 3 different products. The first product, which is coming with either the 4x4 or the mentoring, which is the community. So the community, I'm still pushing hard for people to jump into the community, bringing ideas. I think as traders, if you are a retail trader, you should benefit from it. This is something that in the long run, for the learning curve, I'm really convinced that there is something to do. So I carry on. I'm still posting. I have a great ex-mentees, or subscribers that are still in it and really trying together to make a good community. So if you are joining with the 4x4 as a subscriber, which is the video series that I launched in October 2019, where you're going to have access to 30 hours of videos, meaning it's going to be 40 plus videos, 50 plus Excel spreadsheet, where it's about, helping you getting an investment process, helping you building your infrastructure. There is no added fee, so I'm not going to be asking $500, $1,000 for sending those reports every month. There is no things that I've been hiding somewhere, and I'm not going to relaunch a video series in 6 months just to make a few changes and just to get more money out of it. So everything is there, and hopefully, the subscribers that have been subscribing so far have been really happy, and they are saying that, it's a good product. Mentoring program, that's the next level. This is for people who want to learn with me and with my help how to be managing their money. With the 4x4, you'll be normally completely fine. Having said that, I think it's always good, any thing that you'll be looking at, it's always good to be with a professional and to be going hand in hand with example and building your portfolio. So it's 12 sessions. We do that on Skype or Zoom over 3 to 5 months. It's 1 hour to 90 minutes, where we build your infrastructure, when we do quantitative analysis, qualitative analysis, price action, technical analysis, a lot of risk management, looking at options. So if you're not at ease with options, we start easy and we push. So it's like going to the gym, and I'm the instructor and I always push you a bit harder. So this is about it. Do you have any questions? Any questions? No. If you have questions, send me an email. Again, the CPIs, I think if you've been looking, watching those webinars here on YouTube, and thank you for those of you who are watching on YouTube. That is really helpful. That gives some traction. We know that inflation was there. Question is how strong this inflation is going to be. And as the Fed and the central banks have been putting a lot of liquidity in the system, when we look at the ECB and the Fed balance sheet, a change in those quantitative easing will affect the valuation of those different asset classes. I hope it helps. Market is reopening in 45 minutes. I think it was worth changing a bit the format and doing pre-open. Thank you for joining, and probably talk to you in a couple of weeks. Thank you, everyone. Bye-bye.